Okay, now I'm going to do, I really hope this is the final video on this stuff. And I know project finance people are getting mad at me for doing this, but here I'm going to, this is a little bit of a review. When you have taxes in the capital structure, things change a little bit. And I try to emphasize that if we first compute the tax shield as the gross amount of debt, that's the amount that's in, you normally put in the WACC and it's on the balance sheet and all that. It's not the real economic value of the debt, remember? You multiply that by the tax rate, then you can get the equity. And the equity to capital in the net of tax equity to capital is the gross amount divided by 1 minus the tax shield up here. And then you can get the debt. So it's kind of a three-step simple little process. And then you use KE to compute the same KE we just talked about. That's unleveraging and re-leveraging the beta and all that stuff. You get the KE, the cost of equity with an all-equity capital structure. And then here's what we can do. We can put the same sort of thing in with the constant KE once we have the net of tax capital structure. Now, I'm going to show you when the growth rate is 0 or the tax rate is 0, they give you the same answer. But if the growth rate is not 0 and the tax rate is not 0, we have this little mathematical problem down here. And that's a really review. And here is the first thing the review really does. It shows you in corporate finance, not in project finance, in corporate finance, a whole lot of things and confusing things can be answered by making in this case I made a 200-year model. I think in the other one I made a 500-year model. That's an indefinite model. The ending stuff doesn't even matter. It doesn't, once you discount it, it's just gone. Okay, if you ever see kind of a little decimal difference, that's why it is. Okay, and then we're going to change the capital structure, and we're going to show you again and again and again. This whole business of target capital structure doesn't even matter. And then we're going to do the hard part. We're going to say, okay, this 60/40, well, this is the amount you typically put in the WACC. Then we got to convert it to a net of tax capital structure using that method I just talked about, the tax effect, and then the net equity ratio and the net debt ratio. And really, that's the theme of almost all the videos, except for measuring the debt, beta, and all of that. Okay, so I put in different credit spreads, and we'll use the interpolate function again and all of that. And then we have, I had to make sure this really works, we have an all equity cost of capital, the same as the WACC with no taxes from re-levering, re-gearing. I'll put gearing beta. Okay, good. Oof. Then we put a ROIC after tax. Suppose that could be changed over time, but I'm not going to put it in there right now. And then we have our asset balance, so we have the value of the firm is higher than asset balance because we have a cost of a return that's greater than the cost of capital, and I put a 20% tax rate. Now, for a minute, I'm going to put a 0% tax rate and a 0% interest rate, tax rate and growth rate. Now, in that case, our capital structure is the same. Now, this capital structure, let me put a tax rate in. When I put a 20% tax rate, the step one is to go and compute the gross debt multiplied by this 20% tax rate. Okay, that's step one. That's this, I call this tax effective debt. How about that? All right, this is complicated, so it's hard for me to kind of explain. Now, just to make it kind of easy, then you can say, well, let's take that equity capital and divide it by 1 minus the tax rate, and then you get your effective equity cost, and then you take that equity cost, you put equal 1 minus the equity, that's the debt cost. Now if you want to put numbers in here, the net, when you use an all equity cost of capital, so if somebody's talking about this stupid APV, basically if you use an all equity cost of capital, you're going to get a different result than the WACC when you discount the cash flows, because you have a higher cost of equity, or a higher WACC, or whatever you want to call it, discount rate. That's what we should call it. Now, that's our net. So if we take this net, this amount multiplied by the net of tax thing, we get this. And then we take this times the net of tax, and we get this. Now on the gross side, we put the same equity value, but we add the value of the debt. Now we could add the value of the debt by, and here's the way I added the value of the debt, just divide by 1 minus the tax rate. So that difference up here, this is the tax shield, okay, which is causing us all of these problems. And then if you take the difference between these two, you get the same result. Okay? Enough. All right, now I'm going to go through the same thing. And right now, here's the result. Let's put a 30% tax rate. Is our value going up? Yeah, our value is going up. We get the same after-tax return, but we get a bigger tax shield. And that's the same whether we use the classic NPV at the WACC, taking away the gross debt, that's the stuff you're all used to, or we take the KE and take away the net value of the debt, we get exactly the same result. We don't when it's growth rate. Now if we take the value, the net present value of all of the equity cash flows at the cost of equity, this shouldn't be KE really, it should be cost COE, I'll put COE. Okay, we get exactly the same result, and then we can do the same thing. So we're getting the same result in all these different methods. I didn't put growth. Okay, so here's what we have. We have the value of the company, and then we multiply that by our ROIC to get the NOPAT, which I'm going to ignore depreciation right now. It's fine, I hope. And then we get the value of the assets, okay? And I'm just thinking about that depreciation thing. Now, we could instead, now look at this. If we would have computed the regular old WACC down here, I put it over here, the regular old WACC gives us a different number. We have the same equity cost of capital, but a different WACC because of the way we put the capital structure together, and we put a net of tax interest rate. In the net capital structure, I take the tax out of here and put a cost in, and that's the correct way to do it. But we want to do the old-fashioned WACC. We put a WACC here, and we get the same result. No, we get a higher value of the assets. And here's the difference. And this value of the difference in the value of the asset is the same each and every year, basically. And then I put the gross value of the debt. Now that's an interpolate thing, because I put a change in to get to the target capital structure. That's kind of the thing we talked about, and the gross value goes down. And then we have the tax rate. And then I do that thing of the tax effect. So we take the debt percent and multiply by the tax rate, and we get the tax effect. And then we get the adjusted equity ratio, which is the old equity ratio divided by 1 minus the tax rate, the new one, and then we can get the value, the net value of the debt, which is the debt ratio times the true economic value. And then we can get the total equity value, which is this minus the debt value. And then we can go through our cost of capital like we did before, KE, take the provider cost. This is not the after-tax cost of debt. And then you get the debt portion, you divide that out, you get the equity, subtract it, get the equity portion, and there's the cost of equity that changes. Now the WACC changes over time. Notice that. The cost of equity does not. This is really important. So no matter what kind of capital structure you have, you're getting the same value of the assets. And then we skip this one, and then we take the net debt and get the gross debt divided by 1 minus the tax rate, exactly what I just did up here, and then that's the difference in the value of the debt, which is the same as the difference in the value of the company, I hope. Not true. That's because I'm changing the capital structure, excuse me. Okay. And then we can take the interest cost just based on the gross value of the debt times the interest rate, nothing fancy here, take the tax savings away from that, and get the net debt cost you're really incurring at the company. Now the equity cash flow, or the equity income, is just the total cash flow of the company up here, and you subtract the debt, and you get the equity value. And then you do our tricks. Okay, first of all, you have to put the net change in the net debt. I put the gross debt at first. It's got to be the net debt after that. That's the amount effect economically you're issuing each year. So this goes, it's negative, and then because we have no growth, it goes down to 0. It just changes because we change the capital structure. And then if we use the WACC, the lower WACC, here's the value we get. That's the value upstairs. Here's the gross debt. Subtract it. We take the net method. We get the same result. No growth. And then here's what I do next. This is the sum product, and I just barely have it on the screen. The sum product is the equity cash flow, and we adjust it by the equity cost of capital. And we get the same number each of the 3 ways. And then I went an extra step and said, here's the interest, and take the debt cash flow, and if you take the gross value of the debt, but use the net of tax interest rate, you get this. You get the same net value of the debt, gross value of the debt. Excuse me. So you can do it all these different ways, and you get the same kind of result. And then this is what is completely driving me crazy. When you change it and you put a growth rate in, so let's put a 30% tax rate perhaps, okay? Everything gives you the same. If we put a growth rate of 2%, then the WACC method overstates the value of the assets. It really does. And here's the correct method. This is the other one, and this is kind of our proof. Okay, and we proved it I don't know how many different ways. So what you'd really have to do is, increase the WACC. Now the other thing you could do, I suppose, is put a varying WACC. If you put a varying WACC, 2.5, you get a lower value of the assets. I don't think this kind of fixes it. I tried it somewhere. Let's do put the varying WACC in here, and okay, that's just where we realize that the weighted average cost, it still doesn't really fix it. So there's no magic solution with this growth rate, and it struggled. It took a waste of time to do that, but that's the review. I mean, that's the kind of the last one. And to review this, let's see what I have. Okay, I think you go to the cost of capital section on the website, and I'm just going to talk through this. Okay, I have all of these formulas. The most key formula is this one. It's right here, this stuff up here. Okay, and then I said, well, the debt beta, remember, if that changes, we get dramatically different results. This is the target capital structure. I've got to redo this. This is the tax effects. This was kind of the first thing we did, just to evaluate the tax effects and go through the house example. This one goes through the whole circularity and introduces the growth rate, and I've got to add one more thing here. So, and I'm going to attach these videos, and then I'm going to make a little test as usual. Please think about this. If you have to go to your boss and say, I watched a bunch of videos, so I should get that as my KPI, what is this, key performance indicator, because I did my homework. I'm going to prove that you really did it by putting your name on a page of the website. Isn't that fantastic? And I'm going to give you a certificate. I'm going to put your name. I'm going to give you a badge. And I'm going to check your work. I'll even email your boss if you want. Wouldn't you want to pay 40 euros for that? Okay, if you don't want to, go to your boss and say, I think we should have this program for all of our people, and I'm going to monitor, somehow with like the NSA or something, monitor how much you watch the videos. My son said I could do that somehow. And then I'll demonstrate, number one, that you're not just putting the videos on your phone, and just ignoring them, because you're going to have to answer a couple of questions to prove that you watched them. That's my new products. Enough advertising, okay? And I'm finished. Finished with the WACC and cost of capital, showing how much of all of these articles are, I'm sorry, I don't mean to make these people feel bad, but if you can prove things in Excel, it's a lot better than writing a bunch of ununderstandable